Oh my.
Hey, we are live.
All right. Oh,
Yep.
all right. It's called order the Finance and Audit Committee meeting for November 9, 2023. Cody, will you take roll?
Absolutely. Trustee Cook,
Here.
Trustee Johnson. Here. Trustee Pandolfi,
Here.
Trustee Wyckoff, Trustee Thewis.
Here. Okay, got a form. Agenda is in front of you or online, so no change. I don't have any changes unless you do. I need a motion to approve the agenda.
So move. Second.
A motion and a second. Any discussion? If not, all in favor, aye. Everyone, you know what? Pick roll, it's easier.
Trustee Cook,
Here. Oh, yes, I'm sorry, yes.
Trustee Johnson,
Aye.
Trustee Pandolfi,
Aye.
Trustee Thewis.
Yes.
Okay, minutes. Hopefully you had a chance to review them. Did any changes? No changes or anything? I'd ask for a motion to approve the minutes.
I move the minutes of the meeting of September 14th be approved. Second.
Roll. Take a vote.
Trustee Cook,
Yes.
Trustee Johnson.
Aye.
Trustee Pandolfi,
Yes.
Trustee Thewis.
Yes.
Okay. First up is monthly financials and the rest of the financial reports. So
Yes.
go ahead.
Good morning, Jeremy Wilmeth, Chief Financial Officer for the library. Before you is our monthly financial report for October. A few things to highlight. Revenue is up compared to last year, about $976,000. The majority of that is in property taxes paid by the three counties. The majority of that is from Jackson County for a pilot of payments in lieu of tax. In addition, a payment in lieu of tax. It typically has to do with either a tax increment financing district or a neighborhood revitalization district or some kind of payment in lieu of a tax that has been arranged with either a city or a county.
So is this a one-time revenue item or is this going to be a recurring?
It should be one time. They make lump sum payments.
Well, excuse me, I'm not, if it's a tax increment financing, it's an annualized thing.
The pilot may not be.
Well, the payment of taxes, if it's a 12-year abatement or a 23-year abatement.
Sorry, I thought what he meant by one time was one time a year. Not
Oh, yeah, okay, that's what I want to get clear.
one time a year.
This is,
So this, okay, so this will be, so it is a recurring. Okay, all right.
Well, face it, do you happen to know the project it is? So
I didn't
kind of
have time to
figure out
get
how long
that
it
detail.
is.
I'm sorry.
Yeah, that's fine, but
Okay.
that's,
calls in, but I don't have the detail. So that's compared to the prior year. Expenditures, payroll was up about 7% or 804,000 compared to the prior year. Library materials are down 1.4 million or 29% compared to the prior year. This isn't an actual reduction. This was a change in payment terms for some of the electronic resource database services that we use. So this payment will be occurring in January rather than what had happened prior.
Okay.
And then library programs are up about 210,000 over the prior year. And library operations are up about $60,000 or 2%. So all told expenditures, because of that delay in payment to the database processing, payments are down about 2% or $323,000 from the prior year. I'd be happy to answer any questions the committee has on the general fund.
So relative to the budget, this is just kind of timing of the cash.
Timing, yeah.
Okay.
Moving on to page 3 of the report. The non-GAAP combined balance sheet. comparing cash in the current year with cash in the prior year, cash in the current year, including investments, is 26.7 million. Cash in the prior year was 36.9 million. So we've had a reduction in cash of about 10 million, or 28% compared to the prior year. You'll note under liabilities, under current liabilities specifically, there is a new line called bank loan. That's the line of credit. You'll note that we have used 1 million of the, I believe, 18 million that was authorized for the line of credit. Eight, sorry. Yeah, we've used 1 million of the 8. And speaking with Quan, we think that we've got a few investments that will mature in November. But before we get to the substantial amount of our revenue that comes in December, we believe we may need to borrow an additional $1 million. We'll, of course, keep you informed, and you'll see that in the next report. But as of October 31st, we had borrowed $1 million to cover operating costs, including payroll.
I have a question.
Uh-huh.
What is deferred tax revenue? Like, if that's been on there before, I didn't ask, but what is that?
Yeah, so under generally accepted accounting principles, we have to estimate revenues that will occur in the prior year for the future year. So that would be a deferred revenue. Or the other way, we're going to receive it after the end of the fiscal year, but it'll be applicable to the current year, which would be the tax receivable. So those are really just GAAP accounting.
GAAP or GASB?
Well, GASB through GAAP.
So you have a grant, you have tax receivable up in the assets, and you have, if you have deferred revenue, you have a cash item on the books, correct?
Right. So that would be cash we receive.
So just do the mechanics again, because I'm not. So go through the mechanics again.
So
I get a check
receive
in.
the cash, but we don't recognize the revenue. It's deferred. And when we recognize the revenue but don't receive the cash, it's a receivable.
Right. So why would I not recognize the revenue? This then has to be a revenue item extending beyond the current fiscal year. Is that correct?
Yes, it's cash that we received before the start of the new fiscal year, but the revenue is going to be recognized in the new fiscal year.
All right.
So you charge cash and then credit this deferred account?
Yes.
So to which year does this apply?
This deferred tax revenue would probably apply to the current fiscal year, but we don't, at least I've not noticed that we make these GAAP adjustments except annually before the audit.
So might it be instead of deferred tax as like a prepaid tax?
That's one way to view it, yeah.
Okay.
So this is a year-end 2023 balance.
I believe that's correct.
So why doesn't that get flipped out? I mean, this is the general ledger, correct? And there's just, so amuse me here, guys. And yummy, sorry. So what you have in front of you is called what I'll call the general ledger account, correct?
General operating account, yeah.
Okay, well, but it's the general ledger. And then there are a whole bunch of adjustments that get made, and that's what ends up on the audited financial statements. Correct?
I believe so.
Okay. So this is on my ledger. I have $1.1 million that is sitting there, that was sitting there at the end of the last fiscal year. Why wouldn't I just reverse that well, I have the cash. So shouldn't that end up in my revenues and then my fund balance? Anyway, we don't need to fix this right now, but it seems like this should just disappear as of July 31st every year. And then when the cash hits, if we get prepayment in advance sometime during the current year that pertains to a future fiscal period, that ends up on the liability, in the liability account.
Right, like I said, I don't believe that we're doing those gap adjustments but once a year, but I'll verify that with Juan.
Okay. All right, well, I'd like that clarified and fixed if that's what's going on.
Well, let me, if I have a, can I follow up on that?
Sure.
Because on the asset side, we have that tax receivable.
Again, I don't know.
Which I don't-
related. That's the problem.
Yeah, I assume they're related, but they are different amounts.
Well, so go back, there are adjustments that are made on June the 30th of each year. And another example are unpaid bills, okay? Because for 12 months or 12 months less a day, we're on a cash basis. Okay? And then they make accrual adjustments at the end of the year.
Sure.
And then that should flip out when those get
Which these
paid.
two items seem to be accruals.
Pardon?
The tax.
Those are accrual. I don't know if they're related, but I'd like that cleared up. So
Yeah, I don't.
anyway, okay. All right, that was my question on the balance sheet. So go ahead. Unless there's, Yummy, you okay?
Yeah,
Proceed.
I was gonna say, Gordon, I really appreciate the clarifications. Don't apologize. It really helps me. So thank you.
And just before I get off, is the deferred lease revenue the same type of thing? We collected revenue in advance? Maybe
Yes,
that's a monthly,
yeah,
maybe
so-
that happens every month.
The lease is due to the new gas fees pronouncement that we basically amortize a lease, even though we may have gotten all of the cash up front, we amortize it over the life of the lease under the new gas fee rules.
All right, okay, all right, go ahead.
That is all I have on the balance sheet unless anybody has any questions.
I don't, but I have a property tax related question. Only on our revenues, I know we talked about that's a tip revenue. Just a personal question. Have you received your tax, you're both from different counties.
Yes.
Have you received your property tax bills?
Yes, yesterday.
And I don't expect, Jackson hasn't received it certainly, so I don't know. We'll receive ours, so. I'm anxious since I lost my appeal, as you know, and so. I just want to know if you,
I had no idea.
if Platt and
I
Clay
got
are
mine,
getting their bills.
I got both my business and my personal. So
That's all.
Everybody in Platt has theirs.
Okay.
Proceed.
The next slide deals with the capital project fund. As you all know, the capital plan and the Reading Rocket are the two primary projects in the capital project fund. So you can see there's no expenditures to the Reading Rocket. Looking just at the capital plan, we've spent roughly 27.2% of the budget allocated for the capital plan. And there's no significant changes to the capital plan from what we presented in September. Be happy to answer any questions that you may have on that.
Yeah, good question. Maybe Susan, do we know, I thought the Reading Rocket was supposed to be finished the end of the summer or this fall or
No,
something?
December or January is when we're expecting. Unless there's been an update that I haven't heard, it should be coming in the next couple of months.
I think we do have a confirmed delivery date in
Okay.
January.
January.
Yeah.
Okay, great.
Next page.
Next one. I don't really have anything to report here. These are just all the various grants.
Yeah.
The grants with activity, we've highlighted the grants that are just rolling throughout the year. And then any revenue or expenditures for the entire fund are shown below that line. The next one's debt service, no change from the prior month. Again, just showing debt service schedule.
It's not due till February, right?
Right, I think that's correct. Yes, February 1st, we make a principal payment and interest payment. And then the last report on this section is just of the self-funded health insurance fund. Nothing really to report here. It's all fairly formulaic.
Okay.
That is the totality of the financial.
By the way, the stop loss cost has a cap on it for the plan year, is that correct?
Yes, the stop loss has a per occurrence and then an aggregate.
Well, in terms of, so you're saying that is in terms of claims costs, or I'm just talking about the stop loss? These are stop loss premiums.
Those are stop loss premiums, right?
But that's a capped amount, correct?
Yeah.
And then the exposure side, you're saying on the exposure side, we have, once we exceed the aggregate, that comes back into
Correct.
the library.
Yeah.
Okay. Have we ever come close to that?
That I don't know. I haven't had a lot of discussions with Jennifer on stop loss. So. In the discussions we had about the renewal on the stop loss premium, it sounds like we haven't.
This is a calendar year plan, right?
Yes.
So what's happening, what's coming down the pipe? Because you probably have rates already, or at least still.
That was presented to the personnel committee last night. But I don't have it in front of me. From what I recall, I met with Jennifer a few times on it.
All right, well, we'll wait for them.
Yeah, I felt like they negotiated pretty strong rates with Blue Cross Blue Shield.
Okay.
That is all I have to report. Unless there are any questions, we can move on.
No. Next section. Yeah, if you have questions, chime in.
Sounds like the fire alarm.
Is that?
Good.
I think that's a security alarm.
Yeah,
Oh,
if
it's
it's,
10.
if it's fire, the lights will flash.
All right, that's right.
Emergency strobes.
Still learning the nuances
Yeah,
here.
yep.
On the disbursement detail, I don't really have anything to report. I'm happy to try to answer any questions you all may have. We provided both September and October.
Yeah, do you have any questions? I don't, because I have not had time to look at them in detail. So unless there are questions, let's move to the next section.
Moving on to the investments, we've got our investment activity for the first 4 months of the fiscal year. Again, not really much to discuss here. The operating account technically isn't invested. It's a money market account, but earning a little bit better than the bank rate. The capital fund, as you all know, is heavily invested in bonds, so not much liquidity.
Okay, so I have a question, which is why I wanted cash flow. But so we're sitting at $1.8 million haircut if we liquidate this whole thing. And I don't know what our cash commitments are, but there's about a 100-point spread right now between 3-month and 2-year treasuries. And my quick and dirty makes me think that we should take a hard look at this and see if it's not worth blowing out of this thing. And it may be a little bit of a loss, but you've got, with the inverted yield curve right now, I think some of the stuff that's being priced on the 2 to 5 year, the 5 year is now at 452, or it was this morning. The short term is at 540. So I'll call it 90 points, but there's enough spread there that if we should look at this, that's what I'd like to do. And see if, because depending on what your construction payout needs are, with maturities that go into 27, I don't know what's going to happen to rates. I'm not going to predict, but predict the market is thinking the rates are going to come down next year. I don't know if that's going to happen. We'll know next week. The market's going to hiccup, I think, next week when they have this budget impasse, whatever they do. But the indications are rates are going to be lower because they think there's going to be a recession, which we may be in one already. They just haven't declared it. So if we had the budget, if we had a cash flow we could do it, A versus B comparison and see if it makes sense, because then we would eliminate the borrowing need going into next year, which you guys have already kind of tackled anyway. But I just think I think it's time to take a look at this and see if we can't restructure our liquidity.
I don't mind doing that, but obviously I'm not going to do it today.
In
reference to an organization I'm involved with, serves youth. Yeah, I'd say the bank I talked to is concerned about 9 months from now. They think there'll be a rate limit in 9 months. So I don't mind looking at it, but yeah, it's. I think rates will be down. For rates today versus 9 months from now, I think they'll be lower.
And again, we may not, the purpose is not to make additional income. The purpose is to create liquidity.
Sure.
Because it'll be if we get a push on the ultimate cash flow after 3 years, that's all I'm saying is if we end up in the same boat, I don't have to deal with all these liquidity issues in the fall and much more. And then if rates, if your rates spike, then you have liquidity to take advantage of that. But the other side is we can lock in some, depending on what our needs are, we can lock in these rates for 2 to 3 years at 5+%, about 5%, because the 2 years almost 500.
I don't mind looking at it. I don't know what that rate you're quoting, but yeah, I don't mind a review. I don't mind a review.
Okay.
So, yeah, we'll have conversations and then report back to you next month on what we find.
You may miss the window. That's my concern. So if I can talk to Jeremy after, before the week is up, I can do a quick and dirty and see if this makes sense at all.
Okay.
Because a month from now, the window's changed, I think. That's my concern.
A month, probably too long, but I have another call tomorrow with an entity that is right in the middle of this discussion, so I'll talk to them tomorrow too.
Okay. We can talk afterwards. All right, it's as simple as saying, what's the rollout of the current portfolio? And and that's, what's my cash rollout, what's my income off that? We're getting about a 1% cash yield on the portfolio, okay? So the comparison would be, what if I take advantage of and liquidate the 26 and 27 bonds and get those reinvested at current rates. So in 3 years, do I change? It may not change my ultimate cash flow, but I'm in a much better position liquidity-wise. You're not scrambling for cash.
Okay.
Next.
I think we'll need a action from the board if we want to look at divesting.
I think management has authority to do that. Board, I don't think the board never controlled how you bought them.
Okay.
You don't even need a committee approval. You just, if it makes sense, you do it.
So this is where I'm a little unclear. To me, it sounds like you're directing us to do it, or?
Well, I am suggesting we look at the cash flow because we have a liquidity issue. So we went through all these hoops in the last 6 months to get a line of credit in place. You've gone through and done a bunch of things to level the cash flow, which makes sense, okay? But we still have a liquidity issue in terms of how we're managing the balance sheet. So just saying, I think that the market has given us an opportunity to take a look at this and eliminate some liquidity problems.
Sure, again, I'm just getting down to the semantics
yeah.
of the whole thing. Is this a recommendation or is this a
Yes,
directive?
okay, well,
Yeah,
however you want to phrase it, I don't know.
You know, I mean, that's kind of where I'm unclear.
Well, I think from my perspective, I wouldn't give you that directive today. Would it be for the weekend? Maybe, but I need to have a conversation with some people, which I will be having in the next 24 hours. So I'm not going to give it.
I'm not saying do it. I'm saying, you know, saying the market is giving us an opportunity to restructure the balance sheet.
Right.
And if it makes sense, you as management have the
authority.
To do it.
Okay, so we will do that.
Well, let me ask you something. In 26 and 7, I don't have. So what bonds are due?
A lot. It's on the,
I'm sure it's on.
if you want to look at them, they're on the.
Yeah, I'm sure it's some. That's what I was going to ask you. Where?
They're on board docs in September. I think they're both in the committee and on the board, or maybe it's on the board package, but we don't need to take time.
No.
So, but the bulk of the our maturities this fourth quarter, there are some in 24. I don't know. I don't remember off the top of my head. I didn't bring it with me. But the majority of that 24 matures in 25, 25 and 26, some and 27.
Yeah, I remember it's there. I've seen it somewhere, but okay.
Okay.
And forgive me, my brain doesn't work the same way it does. So I just, if there's an advantage to the organization, the taxpayer in doing this, then by all means, I think we should. So,
Okay.
yeah, we'll look into it.
It's a balance sheet liquidity issue. I don't think, and again, it eliminates you having to do gymnastics and cash flow during the course of the year. Okay. Next schedule.
The next schedule is the personnel spending schedule. I don't have any comments on that, so just want to present that for you all as a question. And then the next one is the capital plan. As I mentioned during the financial report, no significant changes have occurred since the last presentation.
Yeah, and okay, so I do have some questions on this one. All right, on the top section, can you increase the size of that coding just a little bit?
Brian.
Oh, you're not control, okay, sorry. I thought you were running the screen. Okay, so in the top section of revenues, you have project fund balance of 3.7 million. And then below the June 30 line, you have project fund balance, and then you have project fund balance again of 5.2 million. Are those?
I mean, it's probably semantical, but we got the certificates of participation in one lump sum, and then it becomes fund balance.
So I'm talking about you have project fund balance you have revenues as of June 30, which is 117 million, okay?
Right.
Then you're adding in again project fund balance, is that right? Is that?
Right, yeah, so like I said, I was trying to split it between what was spent through the end of the fiscal year that's audited June 30th and project what we need to get to the end of the project.
You're saying that was the beginning balance?
Adding those two together would essentially be the beginning balance, but we didn't spend all of it
at the
end
of
June.
Well, let me ask on that. So the starting point is to add the two project balances together. Starting point.
Yes.
8.89, whatever it is. Okay. All right. So the first one then is expended.
What do you need?
And revenues. The project fund balance is to have a 3.7. Okay, yeah. So what's the difference between that one and 5.1 after June 30?
Well, all right, so I'm going back to the schedule that were was presented in January. And the budget book had 9.505 million, and there was 568,000 committed. So I had 8,936,775 on that schedule, and I okay, there's a nominal difference between that.
Yeah.
Okay, all right, so that's my beginning balance. All right, all right.
Essentially, what we're
I don't
trying to show,
whether we were.
right, what we're trying to show is the money we've actually spent, what we were projecting to spend, and then the difference between what's been allocated in revenues and what we think the expenditures are going to be. Again, the number hasn't changed from September, so
Yeah, well, the
the
number.
format's a little different.
The number is different than what was in January. So the question I had is, because all we really have left in terms of beyond what I think are the committed fixed costs are the contingency amounts. So does this include the contingency? Because on the 3 projects or 4, which were Green Valley, North Oak, East Independence, and Riverside, there's about $1.5 million of contingency.
Right. It's included in that number.
So that's assuming we're going to spend it, or are we going to spend it?
That's assuming we spend it because it's in those.
So my question is, where are we on the contingencies? Do we know? Are we going to spend that? Because I think if you ask for my input on this schedule, I would like to see the contingency separate, because if I'm at a 131.8 and I have a 1.5 million contingency in that I don't plan on spending, then that would be nice to know. So I just presentation issue.
Yeah, I don't know that we're in a place to say that the contingency isn't going to be spent. So that's why we're showing it as a projected expenditure right now. As we work our way through the 4 remaining building projects, should the contingencies not be spent, then that number will be reduced and you'll see a different number. But
Isn't North Oak done, and aren't Green Valley and North Oak both pretty much done?
Sure. And Jeremy, I can't remember the number that we talked about at the last payout meeting, but the contingency exists, but there's substantial work to be done. I mean, we don't really know exactly what could pop up in between now and the conclusion of both projects.
Okay, well, anyway, I'm just.
I guess what I don't want us to conflate construction side contingency with true savings of some sort. I mean, they're 2 very different things. So, I mean, yes, at the end of the project, there may be money left over that will come back to MCPL, but there's a lot of unknowns with both projects. So I think we're happy to report the number. I just want everybody to really understand what the number is and what it means.
Well, and I mean, it's as simple as just footnoting it, saying within the 131.8 is X dollars of contingency of unspent contingency. If you've already committed some, then you obviously take that away. But if you have 1.5 that's not been committed, or and I understand things may come up, but as I say, at this point, you're not aware of anything.
Well, no, I mean, yeah, I can see the number coming down, given some work that we need to do. So,
Right.
Yeah, that number will come down.
Okay. Okay.
That is all
Have any questions?
As we're talking about that kind of thing in contingency, where are we on the water leak at Green Valley?
Oh, my understanding now, Susan, if you have anything to add, I think we're in a good place there, and that all the drywall and repair work is being done, and the problem has been corrected.
Yeah.
So we're in a good place there. And just since we're talking about this so close to contingency, that work didn't draw on contingency to complete, so.
Did we have
So for
subcontractors
our,
that,
so just, I'm sorry. Go ahead.
did we have subcontractors that have kind of stepped up and
Well-
that maybe it was part of their service, I forgot, AT&T, whoever.
The cost to cover the work will be covered by insurance on one side or the other, meaning either that's on the construction manager side or AT&T. And we're
right,
working
that's all.
on getting the details there.
That's fine, but it's not leaking.
What's that?
It's not leaking.
It is not leaking, no.
Currently leaking, yes.
That's assuring,
That's good to know.
not current.
Okay.
It's not raining, so it's not leaking.
Well,
It has rained since we last had this conversation, so we're in a good
Just kidding.
spot. Yeah.
yes.
All right. What's up next?
The discussion on the line of credit utilization, kind of feel like we already did that, but if there's anything else.
Maybe about capital plan, let me just, excuse me, I had a couple of questions. On Riverside, could you just tell me how the land, 'cause that was all before my time, obviously, and land donated or whatever. What was the $650,000 for under property acquisition?
That was the non-cash portion of the contract exchange. So
Okay.
they gave us $650,000 of value for the existing property, and we in turn allocated $650,000 to the land. So we got an empty lot, they get a building in the lot.
All right, and then East Independence.
And they have to tear down the old
something
building.
Similar? Oh,
So
was East Independence something similar? I think that was a transfer of land from
Yeah.
one location to another, or, yeah.
Red Bridge.
Yeah, that was it, that
Yes.
was it, yeah, okay. All right, that's it, thanks.
if you go back, Bob, to the January schedules, if you want to do that, those are shown separately as non-cash transactions. So. I think you already addressed this one too.
Yeah, there's nothing more on cash flow. Budget was the next one. The additional budget schedule that's in the budget document and in the board policy has the budget request being, put together the first quarter of the year. In April is when the budget is disseminated to the various committees, the personnel budget, the capital budget, et cetera. And then in May is when the budget would be presented to the full board. And so what we've discussed for sort of a target for the budget for the upcoming year is that we would add a February meeting of the ad hoc committee to discuss the goals of the board, the budget priorities, if you will, for the upcoming year. That will then inform the process of the department heads that are going to be making those budget requests, sort of to kick off, if you will, the budget process.
And then, just as last year, at the conclusion of the committee presentations, or following the committee presentations, we would have another ad hoc committee meeting just to review what's been submitted and how it lays out. And then at which point it would go to finance, and we'd go from there. So very similar to what happened last year.
Okay, I have some thoughts. So the ad hoc committee, as it was constructed last year, was a majority of the board. And I kind of, you were new. We kind of let you get your arms around things. I would suggest that we disband the ad hoc committee and have that initial meeting, be the full board. Some board members don't want to attend, that's fine. But it is a quorum of the board when you add all the body count together. And I think it should just be the whole board, and same thing for the second committee. So that's what I'll call 2 special board meetings for the sole purpose of the budget, and not call it an ad hoc committee. But you know, I think what you do at that first meeting is to lay out the framework, kind of what your overall goals are, things you want to do. Everybody, you know, understands the direction and kind of the framework you want to use. That then proceeds through the staff and then up through the committees, comes back to the board, or comes back to the board at the second special meeting. You know, it's sort of, you know, I guess the finance committee can go through things at the end, but it seems like, you know, most of the decisions will be made by that point. There really isn't a whole lot for the finance committee to do at the tail end, other than just make sure we have it, you know, we understand things. So that's my view. You guys can offer your own.
Okay. Actually, I was sitting thinking 5 minutes ago, but we probably get to the elephant in the room. And in terms of projected revenue streams, if there's going to be a discussion about voluntary rollback from a couple of years ago, it needs to happen before a lot of planning occurs in terms of what's the available revenue that's going to be divided by our administration. So at what point do we discuss that? Which I think you're getting to also, and that probably is going to have to be obviously a board discussion.
Well, I think so let me give you my view again. The budget should be the expenditure side necessary to fulfill, I guess, what the objectives are and the goals are for that current period.
Sure.
Okay. And to provide some funding for the capital side, obviously to the extent it's needed. I think our capital side is going to be in better shape than we thought. But that doesn't preclude having to fund future payments, because at some point we have to get that in. So that has to be a revenue discussion as well. So the revenue need, from my view, is based on what the budget, the budget expenditures and what I'll call the capital reserves need to be, as opposed to whatever comes in the door.
Well, in order for our staff to prepare that project, what expenditures are needed to deliver the kind of library service that we want delivered?
But I don't have the answer to that.
Right, and that's right, but I would think, yeah, that's right. But I would think that, and that's good to know, but at some point, there's really going to have to be a budget discussion, which is a board discussion. And if I'm putting together expenditures, and I'm not, I kind of want to know, though, what's the revenue stream that is available to me, various types of programming that we may or may not want to do, or talk about maintenance, for example. So I'm just trying to get to. I know. My point really is: at what point is the board going to talk about the voluntary rollback, and should it be remaining the same, or should be some consideration, some increase? And that's all I want to put on the table. Just I'm ready to talk about
Assuming it would be part of those discussions we get into.
I'm sorry.
I said I'm assuming it will be part of the discussions we get into when we have.
Yeah, whatever the time frame. That's my. I guess what time frame is that?
That has to be a spring discussion, and then you'll have you have the assessment data the current year, which obviously isn't going to change. So.
Well, I obviously we have to have that discussion. I don't know.
Yeah, no, I know we do.
Staff
Yeah, I
has
agree.
to.
Yeah.
They want to know more about that before they start putting together their definition of the kind of library services that we want, but I just didn't know the timeframe, but
No, I think that I think that discussion starts when we have that, the budget meeting, and that's part of the framework. But
yeah, sure.
again, historically, I think I can say this with, you know, the revenue was projected based on the assessments and what I'll call the statutory levy, which obviously is the Hancock adjusted levy. And so that was the revenue. The budget then was to spread that revenue.
Yeah, and I just want.
And so,
Yeah.
you know, again, building a budget based on how much revenue I can spend is different than, in my view, than saying this is what I need to run this operation and deliver the services that we think, you know, should be delivered. You know.
And I understand that. It's, and I don't, I mean, maintenance is kind of important to me too. We have a lot of buildings and
Okay.
I want to make sure there's revenue.
And historically, okay, I think I can say this with great confidence. The budget did not include an allocation to capital assets. Okay, 100%. The mechanics were I projected my revenue. I dropped off debt service. Obviously, it wasn't any debt service prior to 19, okay, or there was, you know, a long time ago. And so you had 100% of the revenue going down to expenditures, okay? The allocation to the capital fund was an end of the year number based on what they didn't spend. So that was sort of an unknown until you got to July. Right, Susan? Until I got to July, a year and a month later, or 2 months later, it's like, okay, now I have money left over. Well, it was two things. It was money they didn't spend in operations. And so we gave the impression that we're going to do all this spending, but we didn't. And secondly, you had additional revenue come in from assessment changes, construction, whatever the case may be. And, you know, perhaps being a little conservative on the revenue side. So I'm more of a ground up approach, which is what's the cost to run this place? What do I need to fund assets? Have debt service, okay? By the way, you know, I know this will, some people, but the debt service is a year-to-year budget number, okay? Mm-hmm. If things got in a real bind, we could make a different decision on that, okay? So, and that's how you get to the total, that's your total need. So then I look at that and I look and say, okay, what's my assessment base? What's the current levy? What's the statutory levy? What do we want to do?
Yeah, and I just kind of wonder when we'll talk about that. I'll remember.
But we have to talk about that during the budget process.
Well, that's fine. That's fine.
Yeah.
I just kind of review, you know, any day now will be the celebration of my first year on this board. So sometime this month, I don't really know the day. So I just kind of want to know how we process them.
If I could interject from the staff side, I think there's an advantage to at least beginning to talk about it earlier in the year without making any firm commitments. Because what's being asked of us is to present a fiscal year budget and also present our needs, our cash flow needs for 3 to 5 years. I mean, for example, I mean, you have, is it Navigate? Excuse me. Yeah, Navigate will be presenting, their plan to assess maintenance needs. And based on that plan, we'll know what our budget needs will be for coming years.
So this firm you've engaged?
Yeah.
Okay.
They'll be presenting both to building and full board in the coming month. That's just one piece of what we'll need in the coming years.
Sure. That's right.
So you'll see the immediate need reflected in next year's budget, but I don't think conversations about restoring the levy either fully or partially can be had without looking at what our needs are for the next 5 years.
Right.
Yeah. So we'll be prepared to do that. And I think as a part of the conversation in February, we can present what we think future needs will be, past the next fiscal year. Like areas that we want to invest in and grow, and then our, maintenance needs on the other side. So I vote in favor of at least talking. I mean, I know it's probably not what anyone wants, but I mean, the sooner we talk about it, the better. I mean, I'm not saying a decision has to be made in February, but let's just get comfortable talking about it and what the right amount of revenue is for our organization to carry us forward.
That's why I brought it up. I'm not
Yeah.
afraid to discuss this. I just kind of want to know.
You referred to it as an elephant in the room, and it is. I mean, we're thinking about it too, but we don't have an answer right now.
No.
But I'm with you 100% that it's a conversation that needs to be had. I'm sorry.
Oh, yeah, sorry.
Just, getting back to your comment, I really favor having the full board participate in these discussions, or at least make it available to them. I think that, I recall that I received some questions from other trustees who were not there, and I feel that their input would be very beneficial, and certainly the sort of information that is due them. And along those lines too, I think that we certainly have available to us the opportunity to call special meetings devoted exclusively to this topic, which I think is certainly deserving of its own time for discussion. Well, in particular, feedback from the executives on the needs and the vision for what we'll be spending money. So yeah, full board, and we can meet as much as you want with everybody.
Yummy? Any comments?
No, I agree. That sounds good.
You agree with full board or?
Yeah, with what Ron was saying,
Okay.
I think it probably at least needs to be open for that.
Hey,
Okay,
yeah, I'm good with that. Yeah.
all right.
Or did we answer, your original thought? Are we having an ad hoc meeting or not? I don't, or
No,
the whole
no,
board
this is
invited?
The committee is the whole board. So there is no ad hoc committee. It is a meeting of the board for the purpose of discussing the budget framework and process. Or whatever
Yeah.
else is on your agenda. That's
So Jeremy and
we'll
I,
follow the same path as last year, but it will not be ad hoc. It will be the full board.
we will draft a budget calendar for next year. I mean, a budgeting calendar for next year. We'll present it to you. And Teresa will help us propose dates, and we'll go from there.
Sounds good. Okay. Okay. Next item is the audit. And I just put this on the agenda. I know it's early, but can you skip ahead? Okay. And Brian, can you make that a little bit bigger? Okay. So I just asked because we've had the same auditor for several years. Actually, I think that it was a lot longer than the last 5 years, but this is the fee structure for the last 5 years. Does our policy require us to go out for proposals?
It's a best practice to
It's the best practice. I don't believe it's in the policy.
So you can see the fee schedule. This, I would expect the fees to go up. I don't know what other firms do. It depends on their workload. Way back when I did this, firms would discount their rates for the summer work because it paid overhead and kept staff busy. I don't know if that's the case, still the case, especially because accounting firms are having problem finding staff.
Yeah, I'd say those days have gone because of the specialized nature of understanding GASB rules. There's very few firms that engage in government finance auditing anymore because of the specialized nature.
I find the kids that want to go to school for 5 years to be certified.
But
Well, that's, yeah, we can talk about this separately, but what's your suggestion on this? I guess what's your guys' thoughts? On, do we go out for bids just for, to say we did? And see who is interested in it, and my view is this is not a one-year engagement because the startup cost for anybody doing this has to be spread over at least 3 years.
Right.
Minimum.
Yeah. We're sort of bleeding over into the next item, which is fine, but, we're prepared to send out an RFP in the first quarter of 24. With that in mind, traditionally, I've done a 3-year engagement with 2 1-year options to renew. We may look at a 5-year engagement for that exact same reason. The firm is going to want to amortize their hard costs. So we may get a little bit of a better rate if we guarantee a longer period. 3 to 5 years is best practice. The library's used some form of Cochrane Head and Vic for the better part of 2 decades. So I definitely think that we need to send out that request for proposal. I'm not suggesting that we bar Hood and Associates from submitting a proposal, but at least at that point, we've had a fair review of their proposal.
I want them to propose.
Right.
Well, and we have,
Not really not the incumbent, I'm just saying, so you're suggesting we do go out to bid?
Yeah.
Okay.
and we typically do every 3 years. It's just that Cochrane has always come back within, we've always had. They may have been our auditor of choice for the last, however many years, but we have done other RFPs and they would just happened to be the winning, the firm that was selected after each.
So was decision based on price or based on best fit and price?
Probably both. Quan would have a better answer to that than me.
I don't like buying things on price because.
No, I think it was more than just that, but Quan would have to answer that, not me.
Well, then,
I just want y'all to know, we just didn't go with one company just for the sake of
No.
convenience.
oh, I have a CPA firm on a client who has been doing the work since 1993. And, it's not complicated and there's no need to train people on how things work. And in the end, it's get an audit report and get a tax return filed.
Yeah, my view on that always has been, yes, lowest price, but best. So best has to be a part of my consideration. So that gets the quality, but what they're doing.
Okay.
So, yep, we'll have that responses for you all in the April 24 meeting. I believe that's all that I have.
Other business?
Thank you.
None over here.
Yummy, do you have any other things? I don't have anything else.
All right.
Is that a yes or no? Did you check out?
No.
Yummy?
Yeah, I'm here if I'm just not saying anything because I don't have anything, but thank you for.
Double checking because the rest of us are here. So, all right, if there's no other business, then I ask for motion to adjourn.
So move.
Second.
And voting,
Trustee Cook,
yes.
Trustee Johnson,
Aye.
Trustee Pandolfi,
Aye.
Trustee Themis.
Yes.